Now, first question came in from Morris, but he also asked a follow-up question a little bit later on. And what Morris asked secondary is, in the question and answer box, are you going to show everybody's questions and answers for the benefit of all of us so we can review them again? No, I don't have a method to share the question and to share the answer, because the answer is going to be done on the screen, Morris. It's not going to be a typed out answer at all. I'm going to walk through all the questions that come in using the PowerOptions tools to showcase the profit and loss charts and other ideas. However, we are recording this presentation and it will be archived, and we will look at that a little bit later on as well. Okay. So now to Morris's first question that came in. He says, when we sell puts and calls, cash secured naked puts, covered calls mostly, we never have to worry about the maximum loss as long as we let the option expire worthless, right? I'm going to go ahead and say wrong, okay? I hear a lot of covered call gurus out there who say it doesn't matter what happens to your stock, that if I open a stock position and I sell a premium and I generate a 2% yield, I don't care if the stock goes down because I'm just going to roll the call down. As long as I'm collecting 2% per month, I don't care. Personally, I absolutely care. Okay, I'm in this business, I'm in this market to make money. Okay, doesn't matter if I'm getting 2% per month over a 4-month period. If a stock drops 12%, I'm losing money. My account is down. Okay, you don't have to worry about the maximum loss per se, Morris, but you do have to be concerned. Here's an example. The other day, Texas Instruments had earnings release. Okay, and the stock didn't have much of a reaction. It was because the market was pretty weak. It probably would have had a better reaction if the market was more bullish. In any case, the stock closed at around 59.10 or so on the day before earnings, and the earnings came out after market, I believe, on Wednesday. And so Thursday, the stock spiked up to around $60.61 per share. All right, so at that time, we're just going to use a weekly here. I would have gone further out personally, but I could have bought 100 shares of Texas Instruments at $60.61 and sold the 61 call at that time for about 20 cents. There's only 2 days to expiration, so it's only about a 20-cent premium. Now this is actually a 1% yield. Okay, it's a 1% return if assigned, of course. You know, you get that extra 80 cents there, or about 40 cents of intrinsic value, so you make 60 cents total profit on the position if you were assigned at 61. Good 1%. Otherwise, you got about a 0.3% downside protection, but for a 2-day trade, that's not too bad. However, we all know what the market did today, and as we scroll down below, we see that Texas Instruments closed at about $57 per share. My call that we sold, my 61 call, would have expired worthless this afternoon. Okay, now I can look at this position and say, all right, I generated a small premium for a 2-day trade. I would have knocked my cost basis down to 60.41, allowing this option to expire. But the stock's trading at 57, so I'm down $3.41. You say, okay, well, we're just going to continue this trade. You can go ahead and sell the 57.50, maybe 2 to 3 weeks out, maybe for standard May expiration, to help repair this loss. All right, well, let's take a look how that would turn out. Okay, so let's go back up to our profit and loss chart on PowerOptions, the custom spread tool. We're going to assume that our April 61 call would have expired. This would have adjusted our cost per share basis on the stock down to 60.41. And now we're going to look at the options. Let's say we entered a trade later today. Standard May expiration, the 20th. We're not going to use the weeklies now. Just go to standard expiration. And we're going to look at the 57.5 call, with a bid ask of 96 to $1. So let's say we're going to collect 98 cents today. Well, right before the close, we got 98 cents for that call. So where am I going with this? Well, our option expired. I can rewrite a new call against it. I'm going to generate premium to lower my cost basis, so this is fine, right? This is okay. And we're just going to keep lowering the cost basis by selling these calls. Well, now we've got a problem, okay? Even with the 98 cents generated when we sold the new call, because our first call expired worthless, all right? Now our stock's down to our cost basis, my apologies, is down to 59.43. But I've sold, to get the higher premium, 21-day out 57.5 call. If the stock moves back up, let's say it recovers and it goes back up to $59 or $58 per share, I'm either going to have to put more money in the position to buy to close the call, which will probably increase my cost basis above my original price now, or I'll risk getting assigned at a loss. So when you're talking about covered calls here, if the call expires worthless, what does that mean? It means the stock stayed below your short call strike price. Okay, the call expires, you still hold the stock. Well, if you were selling out of the money premium just to do, simulate a dividend-like income, Morris, and that's your trading plan, that might be okay. But I'm always concerned about this. Excuse me, folks. The reason I'm concerned about this is if the unexpected happened at earnings and Texas Instruments actually dropped 20% of its value, okay, after the earnings event, well, I'd be in a significant loss range now on my position. So what if I can sell another call at the $42 or $43 strike? I'm down almost $17 on my position, right? And that's not a wealth option. That's not a way to grow your account consistently, okay? Now, in relation to the cash secured naked put, if the put expires, this would have a similar risk-reward profile of a cash secured naked put. If the put expires, that's fine. It means the stock moves up, but you just didn't get any positive delta with it. You keep the premium for the short put, and you can sell a higher strike put if you're still neutral to bullish of the stock, or you're trying to get into it at a lower price. Okay? But moving forward, that's why I'm concerned about, yes, I may want my call to expire worthless. Wow. Okay, sorry folks, I'm just scrolling through. There's a lot of questions that came in, no problem. But yeah, if the calls expire worthless, I still have to be concerned about the downside in this situation, because really think about it this way. This was a short-term example because we used that weekly option that was only available for 20 cents, but it was a 0.3, 0.4% downside protection. Really all I've done with the covered call is protected my position by, I'm still taking on, I should say, 99.6% of the risk of owning the stock outright without any insurance, okay? And if I generated a 3% premium and had a 3% downside protection, when I entered a covered call, you have to remember you're still taking on 97% of the risk as you would of owning the stock outright. You do have some protection. You did generate some premium, but the stock falls 30%. It doesn't always happen, but maybe 1 out of every 20 stocks will just do an unexpected event, okay? So that's what we have to watch out for. All right. Second question that came in order was from David. Okay, David's in a married put position, kind of following the radioactive trades. He says, I have the following SanDisk position, 4017 January 80 strike puts at 904 with 3,000 shares. Put value has not changed. Can you tell me about this? What do I do? Sorry, David, I need a cost basis for the stock. I can't just create numbers. So, David, you're going to have to, I'll try to look for it, but I need to know what your cost base of the stock. Now, the market probably fell today. Let's just take a look at SanDisk. I'm going to clear all this out. Put in SNDK. And I'm just going to put in 7513, okay? So you said 80 protective puts at 904. It might still be the same. She probably paid a little bit more for those January 17s. I'm sorry, the stock was probably at a different price. 80 puts at 904. Well, I mean, I'm showing 450 to 670, so there's a big movement there, David, on those positions. Let's see, you said the put value. Okay, sorry. All right, so that was there. Let's just put in 100 shares of SanDisk. I'm sorry for today. And stock. I'm just going to run this. Sorry, folks. I'm just going to run this first here, and we're going to go to the research tool to look back at how SanDisk put has changed. So anytime you want to see the historical data there, just click on the blue information button, whether you're on the option chain, whether you're on the search tool, go to research, and we're going to go to option research. All right, so what we see here is we do have a chart of historically the put bid versus implied volatility. And, going back from January, since the market was released, had highest price. Let's add stock price to this so we can get a better view. So I'm going to compare the option bid to the stock price. All right, that's a little bit better. All right, so when the stock was at 61.74, the 80 put was at 17.13. Stock started to move up, and of course the put started to move down, especially as we start getting closer in time here. So when the stock was at 66, we had about $13 on the 80 strike put. As the stock started to move up, the put declined drastically. It's going down to 450. So again, this is why I say you need your cost basis. If you got in a little while ago, David, and you had it close to a 75, let me just scroll down here, see if David put that information in. Okay. That the puts, okay, that the puts has not changed from where? All right, and that's kind of the key here that I'm having a problem with, David. You say that the puts haven't changed, but from where? What was the stock price when you got in? See here, yeah, the stock's not changing. It's 370, 375, 385, 440. You know, it's right around this, going up to 430, going down to 350, and so forth. That's a reasonable range because the stock's staying right at 75, 76. Nothing's happening. Okay, there's no real price change here. If the stock moved up to 78 or 79, yeah, I'd expect your put to go down to maybe $2 or start declining a little bit more in price, probably only down to $3 or so. And if the stock fell now, if it pulled back and started dropping down to 66 or 67, I'd expect this to go, your 80 put to go back up to the 10, 11, 12, $13 range. This movement here, I mean, over the past from March, say 2nd at 74.98 to today at 76.50, that's not a significant movement. The long puts are always going to lag. You shouldn't expect to see a $2, $3 decline in the put. And actually, with the stock moving up the way it is, sorry folks, with the stock moving up the way it is, in these slow increments that it's doing this, I wouldn't expect much of a change at all. This seems perfectly normal for me. So what should we do now? Okay, what are we going to do with this position? Well, there's several choices. I don't know your outlook for the stock, David. I don't know what your plan is for the stock. Let's go back here. Okay, there we go. So this is, I'm going to use these prices. If I got in today at 75.13 and it's at 9.04. If you're concerned that the stock's not performing the way you expected to, David, you could use income method number 3. Check your blueprint. Even though the stock hasn't moved up, you could use income method number 3 and roll the put in price. Okay? And by doing that, rolling the put in, you might lower your cost basis a little bit, keep some insurance in place around the 80, but you might have a lower cost base to take your risk down to 2.5%. Would you maybe sell a call now? I don't know. It doesn't look like there's going to be any premium here. You have to go at least to the 80, and you're only talking about 10 or 15 cents for 1 or 2 months out. I don't think that's worth it. Let's see here. Let's go back to the research tool again. So before I make any decision, you know, I still don't have your true cost per share. All right, so the next earnings aren't until 7/20. Okay, so we just had earnings recently, and the put wasn't affected. You may have seen a little bit of implied volatility crush on the position. But yeah, what I'm going to encourage you to do, David, I'm still looking through here. I don't see your cost basis, and I don't think your put should move that much based on what we've seen right now on the history of the stock over the last month or two. I wouldn't expect that much movement on the put at all other than what we saw bouncing around between 430 to 385 to 350. That's common. That's perfectly normal, okay? But if you sold to close your 80 put now and brought it closer in time, you might be able to reduce some of the cost basis. You could do that at a credit. But again, you'd shorten your time frame based on your expectations for SanDisk, what your goals are for the position. That would determine what it is. For a better analysis on this, David, later on today or you know, tonight, send me an email. And I know you're in the early morning over there, down under, I believe. But send me an email. You can send it to support@radioactivetrading.com. That way Kurt will see it too, and send us your cost basis for the SanDisk shares. When you purchase those shares and when you purchase the put and the put purchase price as well. Okay. Yeah, from what I saw in the history there in the option detail page, I don't think the put should be moving that much, to be honest with you. This looks like a completely normal change in put price versus a not much change in the stock price itself with a far out put that still has about 280 days to go. Okay, this is Terry asked a question that unfortunately I need more information to answer. Terry says, what kind of stock criteria should I look for and how can PowerOptions help me find those stocks? Terry, I don't know what you're doing. Okay, if you're looking for covered calls, naked puts, bull put credit spreads or bull call debit spreads, that's all one set of criteria. Maybe even calendar spreads, calendar call spreads, diagonal spreads. If you're looking at bear call credit spreads, bear put debit spreads, let's say even maybe covered puts, the opposite of a covered call, you're going to be looking for a completely different stock criteria. If you're doing horizontal calendars, Iron Condors, Iron Butterflies, you're looking at a completely different set of criteria. If you're looking to buy calls and buy puts, you're looking for a more aggressive, probably fundamental and technical set of criteria, depending on which time frame you want to look for. How can Power Options help you? Easy. In every strategy, you're going to see tools that are going to help you find this. There are several sample searches in every strategy that have been created. Okay, so let's just go to covered calls. We have something called the broker and advisor recommended lists. Okay, so for a covered calls trader, we're looking for stocks with good broker recommendations, have to be part of the 5-star recommended stocks by Standard & Poor's, and we're looking for a good downside protection of 3% and also stocks in an uptrend. Okay, well that's what we'd want to see for a covered call, isn't it? We want a stock that's neutral to bullish. We don't want any fly-by-night companies. Sure, we can find positions that maybe offer a higher premium or a higher percentage return, but anything that offers higher return has a higher implied volatility. This search kind of avoids those because we're looking for more quality, stable companies that have a great premium return or an reasonable expected return. Okay? There's, in a covered call now, there's a new tool that Ernie created called Picks of the Day, which shows 1 or 2 positions that match some default criteria. And he shows you what those criteria are right over here on the right-hand side. Okay, but again, that's just one strategy. Let me go to the other strategies tab here, and let me just go back to the default ones so we get a little bit more in there. Okay, all right, but let's talk about this. Let's go here into the covered call search, the main search, where we also have some default settings for you to use as a stepping stone to create your own personal search. I'm just going to go with the initial value screen. Okay, now there's a variety of option criteria, stock technicals, and stock fundamentals. Never get overwhelmed by the search criteria available. You want to scroll through them or screen through them and just put in the criteria that you would use to identify a stock that matches the strategy. Bullish to neutral for things such as covered calls, cash secured naked puts, bull put credits, bull call debits, calendar spreads even. More bullish for things such as married puts, long call positions, long put positions, or married calls. And you want neutral stock criteria for things such as the Iron Condors, maybe even bear call credits and bull put credits as well. Neutral to bearish, neutral to bullish. All right. Now, some of the criteria that we're using here are exactly what you'd think. If I'm entering a neutral to bullish position, which is a covered call is, what are some things I might want to see? Well, I'm probably going to want to look for a stock in an uptrend. I probably want to see stocks that have a good broker recommendation. I want to see stocks that have reflected positive earnings, maybe have a relative price to earnings ratio, and a decent price to sales. I may also choose to avoid stocks that have earnings between now and expiration because I don't want any sudden surprises. Okay, so yeah, we're looking for covered calls. This basic screen is looking for stocks trading above their 50-day moving average, a buy, strong buyer between a buy and a hold recommendation, positive earnings per share growth, reasonable and close in price to earnings ratio, and a good price to sales ratio as well, okay, to reflect good management. That's the same criteria I'll see in some of the default settings for bull put credit spreads, cash secured naked puts, and more. But if I go to bear call credit spreads, I'm going to see a slightly different criteria on some of the default searches, right? And it's one of my safe searches now. But we're going to look for stocks that are below their 50-day moving average. We're going to avoid earnings, of course. We're going to look for stocks that have a poor broker recommendation. We can even use other things for stocks that are below, where the MACD is below the signal line, okay? Or if you use Bollinger Bands, you can look for stocks that are at the low range of their Bollinger Band or broken below it, showing a bearish trend. So those are some of the things you're going to look for. Now, I don't have time to go through each of the criteria for each of the strategies. So what I'm going to do is I'm going to send everyone a link, of course. The bottom of the page, you'll see this appear in your chat window. And it's powerop.com/webinars. Okay? www.powerop.com/webinars. This is our public webinars page. Okay, so you don't even need to be on the trial. You don't even need to be logged into your account to look at it. And so let me see here. On our archive webinars page, there's various tools positions. Here's one on setting up the search tool, which might help you get more ideas on how you can set up the tool for different searches, different strategies. In the option strategies tab, you'll see things such as selection criteria for long options. Introduction to naked puts. We'll talk about the criteria that you'd use for a cash-secured naked put. In the vertical spreads, a hands-on look presentation, you'll see criteria that you'd use to set up a bear call credit or a bull call, bear call credit or a bull put credit spread as well. Let's see here. And then there's some other more detailed information on specifics, Greeks and why you may not need them, implied volatility of the double-edged sword as well. So I would focus on the selection criteria here for long options, which will go through what you'd look for in a bullish or bearish strategy on PowerOptions, or on any service really, what you'd look for as far as criteria goes, and then that will apply to other bullish and bearish strategies as well. So I encourage you to check that out. Go to, oh, I'm sorry, I didn't send the right link. I knew I forgot something. It's powerop.com/webinars.asp. All right, that's the public page. That'll give you access to all of the webinars there. And again, under the Option Strategies tab, selection criteria for long options. This discusses criteria for long and bullish, I should say, and bearish positions. But there's other webinars there that you'll be able to see criteria, such as in setting up the search tool, which you might look for in a bullish or bearish strategy. Okay, next question. John. John says, I'm making my way through the blueprint, RadioActive Trading product. You're halfway done. I was wondering if you could address weekly options with regards to RadioActive Trading. You believe that much as it was created for weeks has any been updated for weekly option strategies? Please share. John, there's nothing to update, okay? And what I mean by that is that there's no difference in applying the RadioActive Trading techniques using weekly options or not using weekly options. It's not about trying to force income methods, okay? So here's an example. Let's see. Oh, I don't have a good example, but let's go back to the custom spread tool here. This is a married put? Yeah, this is a married put. And it offers weeklies. Fantastic. Okay, so here's our position. Let's say I did get into SanDisk a little while ago. This was actually a cheaper premium. Let's say we bought it around 75.13 and we paid 904 for the January 80 put. Okay, so my total cost basis is 84.17. I've got a $5 risk on this married put out to January expiration. And stock happens to be the same price. All right. Now the blueprint teaches 12 different adjustments, everything from simply selling a covered call against the position to doing nested spread trades that take on no risk, ratio call spreads and bear call credits against this position, also broken wing butterflies against the original married put position. So what you're asking me, John, is sort of you're trying to fit almost a square peg into a round hole. You can use weekly options with RadioActive Trading. I do it often, okay? But I'm not going to force it because weeklies are available. Income method number one, which is available kind of for free in the sketch, it shows you just, selling a call against the position. And the idea is, oh, well, weekly options are available, so I just opened this married put, and let's actually say I just opened it today. Let's use the prices today, 450 to 670, so let's call that a nice 580 or so, okay? That's a little bit too high, but that's all right. So we paid 580, so we have a lower risk, 1.1% on the position. What, am I on the right put? Hold on one second. 80 put, 450 to 670. Yeah, that's about right. Okay. Now let's just put it at 6. But yeah, it's a small risk on SanDisk that far out in time. Very strange it's that low. But I only have $113 at risk, John. Okay, it's a very low amount of risk, 1.4%. I said I can start selling some of that right now. So you can sell a call. Income method number one, creating a collar off the married put. Right? But there's certain rules we want to follow. We don't want to sell a call with too little of a premium because it won't give us any positive benefit in the long term. Honestly, believe me. The second thing we don't want to do is ever sell the call below the put strike price because then we'll drastically change the dynamic of this trade. The married put you might have opened, you were looking for a bullish position. If you sell a call too soon and below the put strike price, you're going to create a bearish position. You're actually going to need the stock to fall in order to make money. Okay, so I go in and I see that I have weekly options. Okay, so I'm going to sell the 80 call for maybe 10 cents. It's not going to match the needs. The rules in the blueprint sort of dictate that I want to collect at least a third to a half of this premium. Okay, and at the same time, I want to make sure that I'm generating at least 1% against the position. These are the rules that are talked about in the blueprint. So if I only collect 10 cents right now, just because a weekly option is available, yeah, I can get assigned at 1.9%, but I actually increased my risk. Remember, our risk was 113. or 1.4%. Okay? How did I increase my risk up to 1.5%? I didn't to the downside, I did to the upside. And the stock really takes off now because we collected so little of a premium. Even though we sold the call at our put strike price, we still have increased the risk on the position. The put's going to lose faster, and the call is going to gain one-to-one with the stock. We're not going to get any positive delta, so we've kind of increased the risk to the upside by selling the call too soon. And if we go back and say, okay, well, I need more premium, so let me go to the 7-day out, 77.50. Let's say I can collect 50 cents. It's a zero bid 106 ask. So let's say that we can get 50 cents for it, which is within that range of at least a third to a half of our 113 risk. Okay, so I'm going to put in 0.50. Now our risk goes up to 3.9%. Where? To the upside, because I've sold a call that's well below my original cost basis on the position. Okay, so you can use weekly options, John, just as you use any other option. Let's work another example. Okay, let's say that we got in SanDisk when it was at $72 per share, and at that time we bought the 80 put. No, sorry. At that time we bought. Let's go to 71. My apologies. And at that time we bought the January. Keep it in January. 75 put. With the stock, with the stock at 71, and we had bought this for about 610. Okay. All right. So now we've got a 2.7% at risk on our SanDisk position, a cost basis of 77.10. Now the stock's at 75.13. Okay. Well, now let me go 7 days out, and I'll do the 75.50 for, again, let's say about 80 cents, the midpoint between the bid and the ask. So we're going to sell one at 80 cents. My max risk was about 210, so I'm well within a third of the range. Let's go ahead and submit that. See, now I've taken my risk down to 2% from 2.7, and I have a max return of 2.5. I apologize, the profit and loss chart skewed because I use a 50-cent strike against the standard strike. It's okay, though. But that's what we're looking at here. The stock's at 75.50. We've got a much better risk-reward profile, a much more reasonable upper to lower break-even 7 days out. So here's the trick. You can use weekly options at any time in the radioactive trading techniques as long as it matches the criteria that is discussed. Okay? The criteria that's discussed in the blueprint. If your stock has moved up and you're evaluating income method number one, if a weekly option, either 7 days out or 14 days out, matches the guidelines for when you do income method number one versus 6 or 3, then absolutely you can use the weeklies. There's no need to create a whole separate discussion on the weekly options, because weekly options are no different than standard options. They're the exact same thing, just with a shorter time frame. Okay, there's no other secret to it. There's no mystery to the weekly options. It's just a shorter time frame. That's all it is. So if you find income method number one or a 6 or an 11, you haven't gotten to that yet in the blueprint, I know, but you're probably at around 3 or 4. But if you found an income method number one that's a weekly option, you can absolutely use it. There's no reason to avoid it, but don't force using the weekly options just because they're available, because you'll end up putting yourself in a worse risk-reward profile. You'll actually increase your risk to the upside in the direction that you thought the stock was going to go. All right, Elton, is there a scan to find ITM debit spreads on weeklies at a given profit percentage? Absolutely. Of course there are. Let's go back to our other strategies tab. I'm going to take out bear call, bull put. Let's add in bear put debit and bull call debit. Okay, the 2 vertical debit spreads, all right? Okay, let's see here. Okay, and Jay, your question's up next. All right, so let's save this. And I'm going to go to bull call debit. Elton, let's go into search. Default settings here. Weekly bull call debit search. Okay, so we're looking for bull call debits that are 2 to 10 days out in time, minimum 2% return. Again, it's a bullish strategy, so our other default criteria we can see on the right-hand side here, we want some good average stock volume, stock trading in an uptrend, good earnings per share growth, and you can customize this any way you want to. All right, so it's also looking for a high probability, 70% or more staying in the money. So these weekly positions, right, here's Alibaba. It's the top one, 76.94. It's 0.50 cent strike differences, I swear. As an options educator, they drive me nuts. All right, so the 6th of May 74.50 call, we could sell to open that, buy to open the 73. We'd have a $1.50 spread. It's going to cost us $1.20. But if the stock stays above 74.50 in the next 7 days, we'll make the 30-cent return, which is a 25% yield. We'll be able to close our position, get $1.50 back. 30 cents off 120, we'll make a 25% return. Now these are in the money, Elton, so if you want to be a little bit more risky, maybe you're bullish on the market and you want to go at the money, well, simply lower the probability. I want it to be at least 50%, okay, and then I can increase my return to be maybe up at least to 10%. All right, so now with his LNG, Cheniere Energy, at 38.88, I could sell the May 38 for $1.59 and buy the 36.50 to 2.79, but it gives me just about the same return. All right, so if you want to look for at or out of the money spreads, you can customize it any way you want to. But in the debit spreads, Elton, as well as the credit spreads and covered calls, cash secured naked puts, income strategies, you'll always see a search there for default, for weekly options that you can use as a stepping stone to create your own personal search. So just go into your desired strategy and go into search and you'll be able to see that, okay? All right, and then of course, as I mentioned, you can customize it any way you want to. All right, Jay asked a question. We were just talking about the radioactive trading positions. We looked at SanDisk and so forth. And he says, on the radioactive trading style, why not use a deep in the money leap in place of the stock? Sorry, I'm sure you get this all the time. I do, and I actually have done a webinar, the same webinar a couple times called the 3 comparison techniques. And is there any way to turn the put into a profit instead of just managing the risk? Absolutely, okay, but it's a different income method. All right, let's go back to the married put. Oh, I took it off, sorry. Let's go back to custom spreads. And let me just put in one of mine. July 60, but this is after some adjustments have been made and so forth. I think that's right. Let me take a look. That's about right. Okay, so here's a married put that I'm in right now. My cost based on Texas Instruments about 56.80. I've got the July 60 put, which is coming up to expiration in a couple months at 395. All right, so there's the married put position. But let's your question, Jay, I should do this a different way. Let's take this out. Let's go ahead and add the stock in 100 shares at 57.04, where it's at right now. And if I was opening a position, I probably would right now open the October 60 put for 535, all right? Okay. This is probably going to be a 4 or 5% risk, 3.8, all right? Now, you're asking me, why not use a deep in the money leap in place of the stock? Okay, because when I do that, I'm changing the dynamic of the trade. This is a classic married put setup. I've got 6 to 8 months to expiration, unlimited upside, very limited downside risk, even if the stock collapses, okay? Now, if I take out the stock and I say, okay, well, I want to mimic a 1-to-1 ratio, I'm also going to go out to October, let me buy the 50 call, the stock of 57.04, but with a spit of 665, asset 9 farmers, 280 roughly, so $1.40, so let's put that at $8.05. All right, so I'd buy the 50 call for $8.05 instead of using the stock. Why would I do this? Well, the idea is that, hey, if in a diagonal spread where I buy an in-the-money leap and sell an at or out-of-the-money call, if that's considered a comparison to covered calls in the married put, why don't I save capital and buy the in-the-money leap instead of buying the stock and still buy the protective put? So I can use less money and potentially get a higher percentage return because I'm using leverage. But my friends, leverage works both ways, doesn't it? Let's go ahead and run that. Now what you've done is you've created, okay, an in-the-money long strangle. Has a low risk of 340 monetarily, but it's 25.4% of what you invested. Okay, think about my position for a moment. If I had opened the stock at $57 and bought this put for $5, my investment would have been $6,235 roughly for 100 shares for the married put. I was guaranteed to get 60 back, so I was only risking $235. And you say, okay, well, I want to mimic what Mike's doing, so I'm going to buy an in-the-money call instead of the stock, and I'm going to buy an in-the-money put option. All right, okay, when you do that, and your cost is only $13.40. Yay, that's great. Now, you say, but if it's only $13.40 for one contract, Mike invested $6,200, so I might do 3 contracts here and put this up to about $4,020. Well, remember, now you'd increase your monetary maximum risk up to $900 plus. Actually, be about $1,020. I apologize. $1,020. I'm still only risking $235 of my portfolio. And as the stock stays between the strike prices here, you ended up in that position where you could see the maximum loss. You know, you need the stock to swing down wildly or move up quickly in order to realize a profit. Okay, the in-the-money long strangle is not a parity trade or a comparison trade, but it's a common question I get asked all the time. You're taking on 2 time values now. And I've run several examples of this. I'm actually going to, when I get some free time, I'm going to maybe do some other ones here to answer this question. And Jay, what I'm also going to do is send you an email with the comparison webinar that I mentioned. And there's a YouTube link to it. I don't have it on the top of my head, of course. But it talks about the 3 comparisons that I always get asked. Number 1, why buy the stock and buy the put? Why not sell the put first to get in the stock at a cheaper price and buy the same put? Well, because now you've created a diagonal calendar spread. It's not a bullish strategy at all. It's a bearish strategy. You're trading against yourself by trying to get in the stock at a cheaper price. Why not buy the call instead of just buying the stock and the put? Well, it's because you created an entirely different strategy. Yeah, if the stock fell 20%, you'd have a profit where I'd have a loss. I'm not going to argue that. But the leverage works both ways. You increase your risk, and now you need a wider move in the stock to realize profit to the upside or profit to the downside. The webinar and the articles that I mentioned show that you, with the in-the-money long strangle, you need a much bigger move, and 2 or 3 points more of a move. On the upside, the married put always shows a profit faster than the in-the-money long strangle will. And that's just common option strategy because we're paying into 2 time values here, and as the stock moves up, I'm losing one and gaining on the other. So I need a larger move before the call premium starts to take over the loss in the put premium, whereas in the married put, I have an exact 1 delta. And everyone says, well, why don't you just open a 1 delta on the long call? It goes so deep in the money. Yeah, it's great in theory, but actually trying to implement that, if I tried to buy the 30 strike call or the 25 strike call in Texas Instruments, which right now has no open interest and probably has almost a 4.5 point bid-ask spread, I'm not going to get a good price for it, and unless I pay the full ask price, there's no guarantee I'm getting filled on that position. Okay, so the reality of it is that you can't go that deep in the money a lot of times and get that perfect 1 delta on the call. All right, so that's one of the reasons. But Jay, I'll make sure that I send you an email later on with a link to that webinar, the 3 trade comparisons. The third one, of course, is just buying the call. Why not just buy the call instead of doing RadioActive technique? Okay, so I'll make sure that I get that to you after the presentation. All right, let me scroll down here. I just want to scroll through how many more questions we have left. Okay. Mark says, please, okay, I'll try to do that, Mark. I'll try to send everyone a webinar later this weekend. Send an email later this weekend. I just don't have the links to them right now. Okay? All right. Let's see. Okay, so let me go back up here. Got a couple more questions, about 6 more questions coming in. Oof. Sam, I don't know if I'm going to be able to help you with this, but I'm going to try. Sam wants to know, how can I manage a back ratio spread? It's something I don't trade. On SPY, I put up today for May 6th. You sold the 204 puts. Okay, so SPY, May 6th expiration, 204 puts, and bought 202 puts, 5 contracts. 202, oh, brilliant. Okay, 202 puts, 5 contracts. Okay, let's scroll down here. Get rid of the call. All right. 204 puts and bought 202 puts, 5 contracts. Stock's up 206 in the morning, has gone lower. I bought 2 puts at 207. Okay, let's take a look at this first. So I guess you sold the 204 puts. I don't know what if you just did 1. If you did a 5-to-1 ratio here, and then you bought 5 of the 202s. Okay, I'll just use the current prices here. These aren't your prices, I know. Okay, so there's a ratio back spread. Stock fell. I guess that's what you're doing, but that doesn't look right. I mean, if this is your anticipation, you're expecting the market to drop down below 200 in the next week, and it started to go in your direction that you wanted. Not sure if I got that right there, what you did. Okay. Puts are losing $20. I'm sorry, let me try to read this again. Okay. So I think this is the ratio spread that he's in, Sam's in. Market was down today, which is the direction I think you want it to go. It's just not near your price. And you says you don't have any upside protection. On the close, it was at 26.40. My puts are losing $20. Okay, because you added 207 puts to the position, which I don't know if I would have done. If the stock was going in your desired direction, I just would have let it go that way, if that was your goal for the position. I don't know how many puts you bought here. I'm just going to put one. That's where the ratios get uber complicated because I don't know everyone's ratios here. That doesn't give you protection the upside. Buying a call would give you protection the upside if you think it's going to go the other way. Buying a put doesn't do you any good there. It just turns it into a back position. Okay. You sold the 204.5, yeah. So we've got, oh, you sold the 204, you did 5 contracts, okay. And you bought 5 of the 202s, so this wasn't a ratio then. If you bought 5 of the 202s, then you're just in a, okay, you're just in a bull put credit spread. I don't know if the stock dropped today, but it's not threatening the 204. I'd probably look to do this when the stock drops down to maybe 204.50. I'd consider management. But then you did add those other 207s in for insurance to the downside, not the upside. This is, yeah, this is something I don't know if I'm going to be able to analyze here without the exact number, because it's and you buy the two. Yeah, this is just going all over the place now as we keep changing the ratios. So Sam, what I'm going to ask you to do is send me an email to support@powerop.com. I'm not sure if this is what you have, but if it is, if the stock starts to fall, you're looking better. If the stock starts to move up, well, you're going to have to look to manage it. How would you manage it? Well, maybe sell to close the 207 puts that you bought. Yeah. They leave these open because they're just going to expire, and maybe buy a call. But once you close out these 207s, you'll just have a normal spread now. But yeah, send me an email with what exactly you have in the spread as far as how many contracts of each option, what your price was for each option, and of course, what do you have going forward? I'm sorry, yeah, yeah. Strike price for each option, number of contracts for each option is what I meant to say, and the price for each option. Whew. Okay, send that to me. I'll try to take a look at it this weekend. Sam, a follow-up question. Do you think collar is a good strategy for earnings? It's better than a covered call. It's better than a naked put. All right, because if the stock falls, you've got the protection. What are we talking about here? Let's go back to TXN. Let's say that day before earnings, I would have bought the stock at 59.20. 100 shares at 59.20, 59.40, or whatever it was. And I would have sold the earnings came out, so let's say standard expiration. I would have sold the 60 call perhaps for about, I think it was 85, 87 cents. And at the same time, I would have bought a 58 or 57 put, likely the 58 to keep it a 2-point spread difference. And with a stock at 59 there, it would have been about 40 cents. Let's call it 40. All right. So this is a standard collar position. Pretty good one too as far as the ratio of risk to reward, but usually when I open a standard collar such as this, I usually have my risk at about 3 to 5%. Oh, I'm sorry, that's return. My risk about 3 to 5%, and my return about 2 to 3 or a little bit over 3.1%, somewhere in that range. So it's still a good ratio, but this is almost a perfect 1-to-1 ratio. In fact, it's better than a 1-to-1 return risk reward ratio. But, okay, so what happens? If the stock moves up, well, I only make 1.8%. If the stock collapses, I lose 1.6%. That's good. But most people who play earnings are going to do what we saw earlier. They're going to do that long strangle, an out-of-the-money long strangle, where I may have bought on Texas Instruments the 60 call instead of selling it for the collar, and maybe bought a 58 or a 57 put. So we end up with that curve risk reward. And if the stock falls, we make money to the downside, hopefully. If it pops up, we make money to the upside. By the way, how I played my position was kind of fun. I'll just show it real quick. With Texas Instruments, what I had earlier, how did I play the earnings with my position? Well, again, I had Texas Instruments at about call space of 56.80, holding a July put, 60 put for about the same price. I think it was 365 is what I said. It was about a 1.5% risk or something. Okay, that's too little. I got to put this back up. Let's put it at 425. How about that? Probably too much, but whatever. Good, 1.7%. I know it was below that, but that's all right. So this is my position before the earnings. And what I decided to do is I bought the May 20 60 put for 228. Okay, so I put 228 into the position, but it's a shorter term expiration. And what did that do? That created a straddle. Similar position to the strangle, but it's the same strike price. So this is a synthetic straddle in the Mary put position. Okay. Now, when the earnings came out the next day, the stock, as I mentioned, moved up to 60.60. Well, my put dropped down. This put dropped down to about $1.05, a little bit lower. I wasn't going to sell to close it. What I did instead is I sold, when the stock was at 60.50, 60.60, I sold the 61 call for the standard May expiration. I'm not going to remember the number. What was it? 68 cents? No, 87 cents. Okay? So now I've got this discombobulated sort of strangle position. Why did I do it this way? Because when the stock moved up, the put that I bought for extra insurance declined so quickly, I wasn't going to sell to close it for a $1.30 loss. The stock had really positive earnings and it only moved up about 90 cents or so. It didn't seem right. It should have gone up almost 4 or 5%, I thought. And it looked like it was because of market weakness. So I sold the 61 call for about 87 cents. And then, of course, as you can see, what happened today, the stock pulled back to 57. And at that time, when the market weakness came up, this was, so the stock ramped up because of earnings. It moved up to about 61, but there was a sentiment that it was going to drop back down. So I left my long put in place, the extra long put, and I sold the call. So what happens? Well, I can buy this call back now for about 13 cents, and we sold to close this put for about $3. Okay, so only made 72 cents, okay? But that would drop my cost basis down to 56.02. So let's change that. One moment. And clear that out. And now we have a position that in this case is pretty much close to bulletproof, and we still have a max of 5.2% return, but I can buy this call back at any time cheaply and roll it down. So that extra boost for the long put gave me that synthetic strangle going into earnings. I was able to close it the day after because of this decline in the market today, and at the peak of the earnings, sold the highest strike call, which I can now buy back for almost 80% of what I collected. But going back to your question, is the collar a good strategy for earnings? Yeah, if you want a limited capped gain. And it's better than a covered call because you've controlled the risk. It's better than a cash secured naked put because you controlled the risk. Most people who play earnings with options are looking at the long strangle or the long straddle, buying an out-of-the-money call and put or buying a call and put at the same exact strike price in order to take advantage of the swings, because that's what your expectation is. It's going to swing wildly one way or the other. All right. All right, Doral asks, how can PowerOptions help with trading indexes that expire weekly? Well, as we already showed, Doral, you can look up in any strategy, any weekly position. I actually had a conversation with a gentleman the other day about this. Let's say you're bullish on SPX or any index. Let's just take the indexes as a whole. All right, let's say you're bullish on the bar-based market. The standard index is Charles, and we want to see some bull put credit spreads. Well, there's several ways that you can do it. Number one, I can go in a search by symbol. I could just put in SPX and look at all weeklies, click submit, and then I got a long range of potential positions differing. I can analyze the probability versus the return, but this is a little bit much, okay? How about doing a different tool called the spread chain? All right, so I'll go into spread chain. It's a subtly different tool, but we can set it up how we want. What I'm going to do is say that I'm bullish on SPX, one stock at a time. And so I can click on the put credit and call debit parity, change my symbol here to SPX, and I want a spread width of at least 5 points, minimum net credit of 25 cents. We'll see if we can get that. Range out of the money, about 0.5% for a weekly. We got to lower that down to make sure we see some good numbers. Minimum return, leave it at 4%. Probability, let's put that at 68 to start with. Now I'll just click on the expiration I want. Okay, so I'm going to click on May 4th, 5 days away. Here are the 1, 2, 3, 4, 5, 6, 7. Let me explain this a little bit here. I know it's different than what you've been normally seeing. Here are our bull put credit spreads on the right, and here's the debit spreads on the left. Okay, the call debit spreads. Here are the strike differences we could use if we set it at a 5-point. So we could, with the index right now at 2065, I could sell the 2020 SPX, buy the 2015. I'd get 33 cents for a 5-point spread, which is about a 7.1% return, and we have a theoretical 91.8% probability the stock would stay above that strike. Okay, so this parity view here, the bull puts, put mid is over here, showing you the midpoint prices for the options, what the net credit would be, your range out of the money, net credit return, and then your probability. This is an easy tool to compare what bull puts or bear calls I want to see on SPX. And I can look at any weeklies, 5 days out, the May 6th series, the May 12 days out, 13th series as well. They've got all these different convoluted ones in between and everything. So you can set that up any way you want to. An easier way, Charles, what you might want to create, whether you're bullish or bearish. So I can go directly into the search. Well, I could have done it. There's an easier way to do this, actually. Hold on, Charles. Instead of going to search, I'm going to click over to sample searches. And here's one on ETFs, not the indexes. Okay, so let's go into search. And I'm going to clear the settings. Okay, now I can look for anything I want to. Weeklies, dividend stocks, indexes, ETFs, however I want to do it. All right, so I'm just going to look out for next week. And I can even look at all months. I could even look at a range. So if I wanted to go at least 1 to 18 days out in time to include any weekly on that time frame, I'll do it. What is my return goal? Let's say 5. What's my minimum net credit I'd want? Let's keep that at 25. Out of the money, again, let's go 0.5%. Probability, let's put that up to 68% minimum. We could even go higher. Let's go 70, see if we find anything. All right, now there's different things you can do. I could go into fundamentals and just screen specifically against SPX if I wanted to do that. And you said indexes. I know I'm using SPX as an example. There's 118 SPX results that match that default criteria. I'm going to increase my probability and probably increase my net credit to narrow this down a little bit. Okay? But another thing you can easily do is, number one, you could choose just to screen in the lists section in any search. You could screen just against indexes and ETFs. See any of the spreads that expire in the next 5 days, 2 days, 7 days against indexes and ETFs with what return and probability or range out of the money you want, Charles. In addition to that, you can create your own personal list. All right, so I've created one here in other webinars. So I click on Create and Modify List, and I have my index list. It has 4 symbols in it. My index list is just the common ones: NDX, OEX, RUT, SPX, for example. Okay, so let's go back to our search. And I'm just going to include my index list. But as I mentioned, I'm going to want a higher net credit now. Range out of the money, I'm going to try to go to 1. Okay, let's see if we get any results here. All right, so we've got a ton of SPXs. Oh, did I leave the symbol in? Oh, I did. Let me take that out. Okay, good. Let's submit that one more time. All right, so now you've got Russells, NASDAQs, but again, I still have 237 results. So let's take this down to just what we probably want to see, Charles. Let's just go 8 days out in time, 1 to 8 days out in time. NDX, Russell, SPX. So there's still 94 spreads that expire next week on the broad-based indexes. These are bull puts, mind you, where we're getting a minimum net credit of 35 cents, minimum 5% return, probability of 70% with at least 1% out of the money or more. The only thing I didn't isolate here, Charles, which is very easy to do, is the strike difference. So now I'm going to say strike difference has to be equal to 5, or I could say greater than or equal to 5, depending on how many strike differences you want. And there we go. There's our 3. 2 on the Russell, 1 on SPX. Minimum 1% out of the money. Minimum 5% return on investment or margin. Minimum 35-cent net credit. And at least a 70% probability above or higher. Okay? So you've narrowed down all those various combinations, 10, 20, 15-point spreads on all the indexes and everything else to just 3 that match probably the criteria you might want to look for. And I'm not saying you should look for 35 cents in a net credit. I'm not saying you should go only 1% of the money. I'm not saying you should do a 70% probability. You can easily find spreads here that have a probability higher than that 70%. The problem is they won't offer this return of 5% most likely, or they won't have a credit of at least 35 cents. They're going to have a lower credit when you go for that higher probability on these spreads for a 7-day out trade. Okay? But that's, in my opinion, you've got 3 tools to use, but the 2 ones you really want to focus on, spread chain. Really simple. Put in 1 symbol at a time, 4 basic criteria. What's your goal for spread width, return on the spread, range out of the money, and probability. Or you can use the search tool to clear the filters out. Just put in some basic criteria of your time frame, your minimum net credit, desired return, maybe range of 0.5 or 1% of the money, and your probability. That's probably all you need. And then, of course, your strike difference if you didn't want to do 25 or 20 or 15-point spreads. I could just say less than 10 as well. And then to keep things more simple, if you know the 3 or 4 indexes that you want, just create your list and then select to view just against your list. You've narrowed down the entire universe of options to only those index spreads that match your goals. It's a time saver. I can save this now at any time, and I can just call it My Indexes Weekly Spreads. Search description. Well, it's obvious. So let's just go ahead and save that search there. Now, every time I come into Bull Put Credit and I click on Search, even though I just spent 4 or 5 minutes setting up the criteria I wanted, but now I don't have to do it ever again. It'll just show me those spreads that currently match the last saved search I was viewing. We've done other ones for different webinars as well. But that's how it can help you. Then, of course, as I'm tracking these bull put or bear call credit spreads in the portfolio, as the indexes move up and down, I'll be able to compare my liquidation versus future expiration value, and you may be able to even evaluate some rollout opportunities that we have programmed in the system. So anytime you're tracking a position in the portfolio, whether it's a covered call, a long call, a spread position, or so forth, you'll be able to see that as well. All right, so I apologize. It's 5:32 actually Eastern Time. Let me pause the screen here, and I'm going to go back to do a couple things here. I'm going to go back to the slideshow, and I'm just going to post this up here. If you haven't done so already, remember you can go to PowerOp.com and register for the 14-day free trial. And we do offer a 20-minute delayed service, which is $60 per month, and then a real-time service, which is $100 per month. You can add the back-testing tools on top of that. So I'm going to pause the screen real quick on this image. While I'm doing that, if you do have any last-minute questions, again, go ahead and send those in. And Charles says, thanks a million. That's just what I was looking for. Fantastic, Charles. So you'll want to make sure that you go and register for a trial if you haven't done so already, or if you want to go ahead and subscribe. If your trial ended, just go ahead and do that, and then give us a call or send us an email. We'll walk you through setting up that search. To answer the questions that came in earlier, I'm just going to do something real quick here. I'm logging in to our YouTube channel here, and I'm going to look for that. Sorry, 1 second, folks. I know you're looking at the screen there with the subscriptions up. I want to look for, you need to search for a video here. All right. I think it's called Trade Comparisons. Nope. Okay, sorry folks, it's not. Nope. There it is. There it is. And if you guys can hear my voice in the background, I do apologize for that. Hold on. All right. So show my screen. All right, this is the YouTube link. I'm going to send it to everyone there. This is the RadioActive Trading introduction I believe I did one time. Let's see here. Yep. and I just sent everyone the link. So this is the RadioActive Trade Entry and Trade Comparison. We walk through the benefits of radioactive trading setup and compare it to those leveraged or synthetic entries that we talked about today. So I sent everyone the link there in the chat window. You can try to copy that down. It's youtube.com. I'm not even going to try to go through the codes and the numbers on that. But yeah, our Power Options channel, of course, you can go to the Power Options YouTube channel and scroll through some of these. This should be a public video that you can find. Just look up Trade Comparison when you look up Power Options, all one word, on YouTube, the Power Options channel, and you should be able to find that. Okay? Or just use the link right there, and that'll give you some of that. And then the other articles we talked about need updating, so I'll probably save that to a later date as well. All right, where are we here? Audience view, back to Power Options. I want to go back to here. There we go. All right. All right, so our upcoming presentations, of course, next week, Tuesday at 12 noon, Kurt is going to host a radioactive trading presentation, basic introduction with some other possible concepts in the radioactive trading techniques. Typically Wednesday at 12 noon Eastern Time, we'll do a Power Options tools presentation. Last week we showed tools on how to manage your broken stock. Maybe this week we'll talk about insurance and portfolio protection. Remember, you can at any time view our archived webinars or register for our upcoming webinars at powerop.com/webinars.asp. So that's what we got coming up next week. And of course, we'll be back next Friday at 4:30 p.m. Eastern Time with another open discussion, open forum presentations. Okay. Now, I don't see any last-minute questions coming in. I do want to thank you all for joining me. We're a little bit past 5:30 p.m. Eastern Time. But if you do have any questions you think of later on, just send me an email to support@poweropt.com. Remember, you can also call us during market hours at 302-992-7971. I did record this presentation today, and of course we'll try to post that this weekend, and I'll send an email to all of you letting you know when the webinar has been posted. I should have done that earlier, but I didn't, and what I mean by that is let's go ahead and